Hey everyone, welcome back to Corporate Decoder, the place where we decipher the often crazy world of corporate filings. Today we're diving into Invesco Senior Income Trust's latest prospectus supplement. Don't worry, I promise to make it easier to digest than a plate of alphabet soup. This document outlines Invesco's plan to sell up to 77 million more of its common shares, but the real question is, what's the catch and what does it mean for investors? Let's decode this thing. First, let's establish what this actually is. Invesco's Senior Income Trust, or VVR as it's known on the New York Stock Exchange, is a closed-end investment fund. Think of it as a company goes belly up, as it's known on the New York Stock Exchange, is a closed-end investment fund. Think of it as a company goes belly up. The goal here is pretty straightforward: generate income. They aim to give investors a steady stream of cash while also trying to protect their initial investment. But as always, there are risks which we'll get into. Now, how does Invesco plan to sell these new shares? They're using a distribution agreement with Invesco Distributors, which then has a sub-placement agent agreement with Jones Trading. Basically, Jones Trading will be selling these shares for them. They'll get a commission of up to 1% of the gross sales. All of this is a way to get the shares out into the market, but it also means extra fees that come out of the money the fund makes. Here's a key warning. Closed-end funds often trade at a discount to their net asset value, or NAV. This means the market price of the shares can be lower than what the fund's assets are actually worth. So investors buying shares in this offering could face an immediate loss if that discount exists. The report explicitly says this creates a risk of loss for an investor purchasing common shares in a public offering. It's worth repeating and remembering. Alright, time for some number crunching. The report has a summary of fund expenses that breaks down exactly what shareholders will be paying. Total annual expenses are a hefty 5.26% of net assets. That's a big chunk of change. A big part of the expense is due to borrowing costs, also called interest payments on borrowed funds, which are about 3.53%. That's pretty significant. The fund estimates that it'll take about $308 million after sales charges and offering expenses. They are planning to use that to invest in accordance with the fund's investment objective. Let's take a look at the fund's recent market performance. There's a big table showing the high and low market prices, NAV and Accession, and the premium or discount to MV. The shares have traded both at premiums and discounts, and as of March 17, 2025, they were trading at a 743% premium. This changes, but as we saw, shares will generally trade at a discount, and you should be aware of that. Now, for a recent development, the Board of Trustees terminated the Managed Distribution Plan, or the plan. This plan was designed to give shareholders a consistent monthly payout, even if the fund didn't earn enough income that month. Now that it's terminated, it could negatively affect the share price. Last but not least, let's talk about the legal side. Certain legal items are being looked at by Stradley, Renon Stevens and Young, LLP. The fund's governing documents include provisions that could limit the ability of other entities or persons to acquire control of the fund or convert the fund to an open-end fund. These provisions could have the effect of depriving the common shareholders of opportunities to sell their common shares at a premium over the then current market price of the common shares. Okay, so what's the takeaway here? Invesco Senior Income Trust is aiming to raise a lot of cash. The risk of buying high and seeing an immediate discount is real. The expenses are high, especially those interest payments. This means the fund needs to perform really well to justify those costs. If this fund relies heavily on senior loans, the value depends on things that can't be predicted. A good part of those risks are external. The termination of the managed distribution plan was a surprise and could make shareholders uneasy, as the benefits may reduce their holdings. So while this trust has potential, investors need to be aware of the risks. It's definitely not a set it and forget it type of investment. Now, I want to hear from you. What do you think about Invesco's Senior Income Trust and this offering? Is it a good opportunity, or are the risks too high? Let me know in the comments below. Don't forget to like and subscribe for more breakdowns of the corporate world.